I'm Robert King, and I'm filling in for Charlie Calamaris, who is regrettably ill and stuck in New York, but is going to appear to us virtually later to do a presentation. I'm delighted to introduce the panelists, which are a remarkable combination of individuals that I've met in many different intellectual contexts. Remember reading papers by Loretta Mester on banking. And then later, I was delighted that when she became the president of the Federal Reserve Bank of Cleveland, she had the wisdom to appoint one of my former students, Ellis Tallman, as her research director. Bill Nelson knows more about banking and the Fed than anyone I know. The knowledge is remarkable. It's based on many years of experience inside of the Federal Reserve System and now at the Bank Policy Institute. He's sharing things more broadly. And then, of course, we have Darrell Duffie, who's got to span financial markets in ways that are preposterous. On the one hand, you have the originator of much of modern financial theory, particularly as applied to derivatives pricing, term structure, and so on and so forth. You have the author of Dark Markets, and then you have a man who's willing to get his hands dirty with the plumbing of the financial system. So with that introduction, I'd like to ask Loretta to talk to us.
Thanks. Well, thank you very much. And I really thank the organizers for inviting me to be here today. It's been a great conference so far. Charlie Plosser was the one who introduced me to SOMC, and Mickey Levy as well. And, I think, we talked a lot today about all the ideas that were generated by the SOMC and how important those ideas have been in driving better policy. But I think the other important thing about the SOMC, particularly for a body like the FOMC, is that it really does foster this thirst for different ways of thinking about things. And I think that's probably as important as the ideas themselves, is this real, instructive way, example of how you bring together people who may be thinking about things differently and coming up with sort of a view of the world and a way of sort of bringing those ideas together. And it's been instructive, I think, as much as we've talked about some of the weaknesses of the FOMC process. I think SOMC, by showing that there's other ways of thinking about things, help the FOMC avoid groupthink. And I think that's very, very important. The SOMC, I think, also really, it not only tolerates opposing ideas, it actually champions people who have opposing ideas and different ways of thinking about things. And I think that's been a real important example to policymaking bodies like the Fed. So I do feel honored to be here. So what I'm going to do in my panel remarks is I'm going to just make one simple point. And that point is that the current ample reserves framework is not that simple. Okay, so just to fix ideas, this is a session about the operating framework. And just so that everyone's clear, when we talk about the monetary policy operating framework, it's about how the central bank implements its policy rather than what the policy actually is. So once they choose their target, this is how do you go about and make sure that your interest rate target is met. And so really, if you think about the principal attribute you want of this framework, is that it allow for effective control of a policy rate that's sufficiently tied to other market rates to allow for that transmission of monetary policy throughout the economy. It has some other things that you'd like it to have. It'd be good if the framework worked in different economic circumstances and market circumstances so that you don't have to keep changing the framework every time the economy changes. And in particular, you don't want the framework to make financial stability problems worse. And even better than that, you want it adaptable to any kind of actions that are taken to address financial instability or market dysfunction. So the current framework that the Fed's using involves a very high level of reserves, as we talked about earlier today. And in January 2019, the FOMC went on the record and announced that it intends to continue to implement its monetary policy in what they call an ample reserves regime, also known as a floor system. Now, the Fed still continues to communicate its policy by setting a target for the Fed funds rate, but it implements its policies through administered interest rates, interest on reserve balances, or the IRRB rate, and the interest rate on overnight reverse repurchase agreements, the ONRRP. Now, before the global financial crisis, of course, the Fed operated in what is called a scarce reserves operating regime, also known as a corridor system, in which the FOMC actively manages supply reserves in order to achieve its Fed funds rate target. Now, I submit that both the scarce reserves regime and the ample reserves operating framework have proven to be effective during the periods in which they've been used in terms of being able to control the interest rate. But the switch in frameworks was really necessitated because of the policy choices that were made during the global financial crisis and the pandemic. So I thought it would be useful just to show you a couple of charts that illustrate just how much the Fed's balance sheet has changed in terms of both its size and composition. So in January 2007, the Fed was holding less than $900 billion on its asset side of its balance sheet. And on the liability side, banks were holding about $20 billion in reserve accounts at the Fed. During the global financial crisis and Great Recession, of course, the Fed engaged in 3 rounds of quantitative easing. So assets rose to over $4.5 trillion in January 2015, and that was the peak during that period. It was a 5-fold increase than before the financial crisis, and we thought it was very, very large. Of course, on this chart, it doesn't look so high given what happened later on. Reserves peaked at $2.8 trillion in November 2014. Now, at such high levels of reserves, the Fed really couldn't use its corridor system to control its policy rate. But then in October 2008, Congress gave the Fed the authority to begin paying interest on reserve balances at the Fed, and that allowed the Fed to use the floor system. So that went along for a while. We got out of the financial crisis. And then in October 2017, the Fed began gradually reducing the size of its balance sheet by allowing assets to begin to roll off. And as a result of that, reserves had moved down to about 1.4 trillion by the middle of September of 2019. And of course, that's when the repo rates and other short-term money market rates began to spike. So at that point, the Fed concluded that it probably had let reserves fall too much, that it had neared the point of scarcity, and it began purchasing assets again. And of course, as everybody knows, the pandemic struck in March 2020. So the Fed bought assets. Now, the first group of that asset purchases was really to address dysfunction in the Treasury market, because the thinking was it would be a very bad idea to have a financial crisis on top of a pandemic crisis. And then it segued into, once the funds rate was brought down to 0, adding monetary policy accommodation. Of course, the Fed wasn't the only central bank doing this. Other central banks also purchased assets during the pandemic. I think the chart on the left is one that Axel showed us earlier this morning. Other central banks also bought. This is as percent of GDP. So it's, we were one of many that were doing the same thing. Then when the economy recovered, the Fed began a second normalization process, or a second QT, quantitative tightening of the balance sheet in June 2022, and that's still underway. So when that started, that normalization started, the Fed's balance sheet assets had risen to nearly $9 trillion. So about double the peak during the first global financial crisis period, where we grew the balance sheet. And that's about 35% of GDP. Reserves were over $3 trillion, or about 12% of GDP. and ONRRP were about 2.5 trillion, or about 10% of GDP. And then since then, assets are down about 1.8 trillion. ONRRPs are down about 1.7 trillion, but reserves have actually risen a little bit, a tiny bit. So they're still at about $3 trillion. They've fallen as a share to GDP, but in terms of nominal levels, they haven't really fallen. Now, one of the purported benefits of ample reserves of the framework is that it's simple. And I would say it is simple, at least on paper, it's simple. So, in the scarce reserves regime, the Fed estimates the daily demand for reserves, supplies the amount of reserves needed to hit the funds rate target. In ample reserves, the FOMC doesn't have to do that actively management of the supply reserves based on estimates of reserve demand. It just supplies enough reserves so that banks are satiated. And so they're willing to invest their surplus reserves in other high quality assets if the market rate is higher than what they can get by holding those reserves at the Fed, the IORB rate. And they're willing to lend them if they can earn a rate that's very near the IORB rate. So basically, the Fed can control the funds rate by setting that IORB rate, which is an administrated rate, and the kind of typical reserve fluctuations that you would see don't result in changes in short-term market rates. So that simplicity and efficiency of not having to estimate that reserve demand on a daily basis in an ample reserves regime is appealing. And I seem to recall, and my colleagues can say whether I'm just making this up, but I do seem to recall that there was even talk that the Fed would save on resources because they wouldn't have to hire as many people to actually do those kinds of estimates and have the knowledge to be able to estimate reserve demand each day. It's a good story, even if it's not true, but I seem to think it's true. Okay. But, this is all, sometimes, right, the theory is very compelling. It seems like it's a simple operating procedure, but the real world doesn't always cooperate. And in the US, we have very complex and segmented money markets. And that means that IORB rate, the interest rate on reserve balances, doesn't really provide what I would call a strong floor. So in particular, if you think about the Fed funds market, the federal home loan banks do 90% of the lending in the Fed funds market. And they do not earn interest on reserve balances at the Fed. So they're willing to lend in the Fed funds market at a rate, any rate above zero. So that puts downward pressure on the funds rate. Similarly, money market mutual funds don't earn interest on reserves, but their lending in the money markets can influence the trading in the Fed funds rate market. So the Fed has had to establish an ONRRP facility, and they did that in December 2015, when they were, moving rates off that zero lower bound. So because they were a little concerned that we wouldn't be able to move the rates up. So that facility is open to a broader set of money market entities, including the money market mutual funds. So by controlling that rate, the rate on ONRRPs and IRB rate, the Fed can effectively put a firmer floor on overnight interest rates. The other complication is that, the discount window, the primary credit rate, is supposed to be a ceiling, but because of stigma at the discount window, that didn't really fulfill its role that it does in the simple framework. So the Fed established the standing repo facility to alleviate upward pressure in repo markets, which can then put upward pressure on the funds rate. And I think Darrell's going to maybe talk a little bit about that in his remarks today, about how well that worked. Okay, so not having to estimate reserve demand each day, again, is a benefit. But that doesn't get you out of the bind of having to know when reserves are actually approaching scarcity. So you may not have to estimate reserve demand every day, but you have to know something about the demand curve for reserves, or else you have this danger that you may be allowing reserves to get too small, and then that undermines sort of the simplicity of the framework. So that's not that easy to do, we found out over time, because bank size, business model, how banks manage their liquidity, the regulatory burden each bank faces for maintaining high reserves, all of that can affect their desired reserve levels. So the distribution of reserves across banks matters. It's not just the aggregate level of reserves. Um, and then moreover, that demand curve for reserves can move around with market conditions. So, there's a lot of monitoring that the Fed has to do, and the market test is doing that. And there's a number I give you a number of things that, is public domain of what we're monitoring, what the Fed's monitoring to ensure that it doesn't hit that, it stays bigger than the satiation point. And we're right at the satiation point. So I don't think that's that simple. It also isn't clear that one of the touted benefits of the regime is that it's better for financial stability. But there's some really interesting work by Viral Acharya and his co-authors, where basically what they're showing is that an increase in reserves may not increase liquidity, even though people think that higher reserves means better liquidity, because banks typically, when reserves increase via QE, they actually raise how much direct claims are on those reserves. So in other words, they'll increase demand deposits, they'll increase credit lines. And then when QT happens, when reserves go down, they don't lower those claims. And so what ends up happening is you have this ratchet effect that as QE happens and then QT, you end up kind of getting higher levels. And the implication of that is then, because there's more demand on those reserves, right? When there is a financial instability, banks are not trading those reserves from where they're scarce to where they're ample. And you don't have that going around. And so the Fed then has to come in, or a central bank has to come in and actually add liquidity in those places, even if the level of reserve seems like it's high. So that leaves the banking system really vulnerable to liquidity shocks and more dependent on the Fed than in the prior regimes. And what Viral and his co-authors argue is that asymmetric behavior of the banks during periods of QE and then in periods of QT, which they call liquidity dependence, other people call it a ratchet effect. They think it was likely the cause of what happened in September 2019 and March 2020 when there was a lot of market stress. So that's just a cautionary tale that just because there's a lot of reserves in the system doesn't mean they're going to get to where they need to get to alleviate stress. And then there are a lot of other issues with ample reserves. Claudio Borio points out about the fact that, when the central bank ends up having to play a more significant role in the interbank funding market, that means they also then have to do more injections of liquidity when there's stress on the market. Other central banks like the Norges Bank and the Swiss National Bank have actually switched from being a pure floor system to being a system that has tiering, so that they're trying to incent banks, right? Give them the incentive to go back into the overnight bank funding market. And the ECB recently changed their supply-driven floor system to one that's more demand-driven. So there are banks that are concerned about the fact that there's less trading in the overnight banking market, and they're trying to give incentives with their operating procedure to actually get that to be a more vibrant market. For the Fed, I think the shrinkage in that overnight banking market has implications for what interest rate the Fed wants to actually target and communicate its policy in. So, and there was discussion in the November 2018 FOMC meeting about whether the Fed should switch away from the Fed funds rate because of the lack of trading in that market, which means it's a more volatile interest rate, to another a broader open market overnight bank funding rate. In the end, the FOMC stuck with the Fed funds rate on the argument that it was, what was a communication policy that everyone in the markets had grown used to. Charlie Plosser, who's here, has done a lot of important work pointing out a number of the political economy costs if the central bank's balance sheet can grow to any size without any limit put on it by the operating procedure. Because remember, in the scarce reserves, there is that limit being put on the balance sheet, including the potential that Congress or the administration could use the central bank's balance sheet to fund fiscal policy initiatives. And I have to say, when I was putting the slides together, I ran across an article in the FT last week. It was an op-ed column by Nathan Tankus, who was recommending that the Fed set up a disaster relief 13.3 facility. I don't know whether anyone else saw this, for municipalities hard hit by hurricanes or other natural disasters. And he basically was arguing that the Fed should use the balance sheet in that way. And in particular, what was striking in the article, it was part of the argument was that it would alleviate the problem caused by the fact that FEMA is subject to the appropriations process. So again, we can talk about that later, but I found that striking that, people think that these are idle issues, but they're not idle issues. They're still there. There's a bunch of other appearance issues here. We're paying large interest payments to foreign banks and to large banks. We give the appearance that we're not able to unwind QE, which could undermine use of QE in the future. I know some people in the audience would say good riddance, but you don't want to you want to keep your tools for use later. So that's a problem. And we haven't been remitting anything to the Treasury since September 2022. And of course, that may generate criticism. So I just wanted to put up some things that I took from the transcript of the December 2018 meeting. And, these are quotes from Jay Powell. And I think these quotes really underscore the fact that the Fed does understand that these political economy issues and appearance issues are serious. And, you can argue about whether they should go faster in trying to reduce the balance sheet, but I think they do understand that there could be implications if they don't bring the balance sheet back down. So in conclusion, I would say the ample reserve system is meeting the prime directive. It has allowed the Fed to control interest rates. I don't want to necessarily want you to conclude that Mester now thinks that we should go back to scarce reserves, because frankly, I think it would be very difficult. I think the cost of going back would be, probably high, and one would have to do a cost benefit analysis of the transition costs. But I do think it's important to be realistic about the system. It's not as simple as it's purported to be. It takes a lot of care and feeding. It reflects a choice about the Fed's footprint, right, in the markets. You're making a choice by going with this system. And the larger Fed footprint may distort private sector liquidity risk management in a way that, even though there's high reserves in the system, it may not be a more stable financial system. So I think there probably would be work that could be done to evaluate some of the things that the other central banks have done to see how they would work in a U.S. context, which would maybe help limit the size of the balance sheet and put some limit on the floor system in the U.S. Thanks.
Thank you, Loretta.
All right. Well, let me first thank Mickey and Michael for the invitation. I'm really excited to be among this group of folks, and I'm very happy to be celebrating the 50 years of public service of the Shadow Open Market Committee. And Bob, thank you for those extraordinarily kind introductory remarks. And I can honestly say I can't imagine a panel I would be more happy to participate in than with my friends Loretta and Darrell. So I'm going to focus, there's going to be a lot of overlap actually with my remarks with Loretta. I'm going to focus on why the choice of monetary policy implementation framework matters. I think that some people still look at this and they say, honestly, it just doesn't matter that much as long as the interest rate target is hit. This is sort of extracted from a longer paper I recently published on telling the whole story of how the Fed got so big and talking about how it can go ahead and get smaller again. So my ambitious plan is to talk about the ratchet and the demand for reserves that Loretta mentioned. I can maybe go lightly over that. then point out how the Fed replaces the interbank market, something I see as a cost, and then dive into the costs of what I see as the Fed becoming somewhat more complacent about the size of its balance sheet and the risk that it's undertaking, but perhaps more consequentially, costs from others outside of the Fed now seeing its balance sheet as an attractive way to fund things, and the resulting risks to Fed independence. And then we'll discuss why the Friedman rule, or what Ed Nelson tells me really shouldn't be called the Friedman rule, that some see as a benefit of the floor system, isn't really a net benefit. And then end with some reasons to be hopeful about the future. So all discussions of monetary policy implementation frameworks begin with the Poole model. Bill Poole was a member of the SOMC for 14 years. Loretta already used the model. It's a model of the determination of the funds rate given the quantity of reserves provided by the Fed, where the orange bar up horizontal lines are the quantity of reserves provided. And the purple line is something like a demand curve. I'll talk to you later. It's not really, but nevertheless, it traces out sort of what Fed funds rate will prevail given that quantity of reserves based on the quantity of reserves that banks want to hold. And of course, under the corridor system, the Fed provided reserves set a target in the middle between the discount rate and the interest rate on reserve balances. It was actually zero for much of that. That's why it's called a corridor system. And in the floor system, they provide an abundant quantity of reserves, pushing the interest rate down to the interest rate on reserve balances onto the floor. Now, what the proponents of the floor system, they misused this model. If you go back and read the paper, the model is about the determination of the Fed funds rate within the day. It's about decisions that banks make at the beginning of the day, unsure about what's going to hit their account at the end of the day. And Poole in the original paper says the model presented here concentrates on these very short-term adjustments. However, it is obvious that the bank must make further adjustments if it experiences persistent reserve drains or accretions. And it's those further adjustments that have really tripped up the floor system, as Loretta has already discussed to some extent. So what was the story behind the floor system? The idea was that the Fed would provide such a high quantity of reserve balances that the demand and supply could move around some without the Fed funds rate really moving in a meaningful way. So the Fed wouldn't need to have to make short-term interventions. And Loretta's done a great job saying, well, that story of simplicity really didn't get borne out. And partly that's because as the Fed provides reserves, banks adjust their balance sheets. They make use of those reserves. They don't just sit there idly in the account of the Fed. The banks adjust. Moreover, examiners adjust their expectations about the quantity of reserve balances that banks will hold. As a result, if you still want to think about things in terms of the Poole model, you can think of the whole demand curve shifting out. And so you're always kind of near that steep part. So you always can end up being tripped up by changes in the supply and demand. Now you can see the consequence of this ratchet in this. The table shows the Fed staff's estimate of the quantity of reserve balances that would be necessary to implement a floor system. Now the first estimate was done in April 2008, soon after the Congress granted the Fed the authority to pay interest on reserves, and the Fed did a big study to say, how should we use this authority? And they looked at a lot of different options. One of the options that they looked at was a floor system, and they rejected it out of hand as being much too radical. But as part of looking at it, they estimated, well, what quantity of reserves would we need? And they concluded $35 billion. Now, the most recent estimate, it's actually April 2024, from the Fed staff and the staff of the New York Fed, was that it would take $3 trillion. And you can see it just marched up in between. That's nearly 100 times higher. Now, you can also see it in the relationship between the spread of the funds rate over the quantity of reserves, but I'm going to skip that. This is my illustration of how simple it was to conduct monetary policy before, but I'm not going to talk about that. So what are one of the costs, or at least what I perceive as a cost? The first thing is that the interbank market withers. Under the corridor system, at the end of the day, the banks with extra reserves lend them to the banks short of reserves in the Fed funds market. Now banks are overstuffed with reserves, so there is no such trading. And as Loretta noted, the trading is really just this strange arbitrage play between the FHLBs and US branches and agencies of foreign banks. Now, some might say, well, so what? The whole question is, who cares if there's a lot of reserves? And there's a lot of people who would say, I don't miss the Fed funds market at all. But other central banks see this as a serious problem. So the Norges Bank, for example, in 2010, switching from something like a floor to something like a corridor, said they were doing it because they perceived that when they provided a lot of reserves, banks start not managing their liquidity as well. And I'm going to read the quote from Andrew Bailey, because that was just a few months ago, the governor of the Bank of England, describing the reasons why the Bank of England is basically getting up off the floor. And he said, generally speaking, as reserves levels grow, the incentive for the banking sector to manage its own liquidity risk falls. And to the extent that reserve supply crowds out healthy market intermediation in normal market conditions, a large part of the financial system's ability to manage its liquidity will be effective. Now, I think back to Connie Rice's introduction at the beginning of this event. I value markets quite a bit, and I think that they're important things to preserve. And I think that's reflected here as well. So another cost is that discount window stigma gets worse. Under the corridor system, borrowing from the discount window was relatively frequent, and most of that borrowing was for monetary policy purposes. Now borrowing is rare, and it's almost entirely because the individual borrowing bank is in some kind of stress. So it used to be my job back in 2003 and 4 and 5 to go out to banks and convince them to use the window. And I could claim legitimately, it's no reason to associate the borrowing really with troubles at your bank. Now it's a lot harder to do that. And we know this is costly. We know that stigma is costly. Now, it happens for lots of reasons, but this contributes. First of all, it adds to that ratchet. Banks demand such high-level reserves in part to reduce the risk of having to borrow to zero. If you never want to run an overdraft, you need to have a lot of extra cash in your account. But even more consequentially, the lack of preparedness to borrow was a significant factor in the banking turmoil in 2023. And I would argue it really contributed to making it systemic and the need for government intervention, because the Fed looked around, they said, banks don't have enough liquidity at the discount window. If there's a run, there's going to be trouble. Now, another consequence is that bank examiners expect higher stockpiles of reserve balances. If you go back before the global financial crisis, nobody expected a bank to hold reserve balances to meet liquidity needs. They didn't even pay interest. Banks, I'm reading the examination manuals, examiners judged a bank to be liquid if it had well-diversified, reliable funding and access to the discount window. And abundant and cheap reserves have led to a sea change. And in particular, the internal liquidity stress tests that banks are required to perform, and just examiner preferences favor reserve balances. In David's excellent podcast, Macro Musings, Vice Chair Randy Quarles stated that those examiner preferences were what led to the abrupt end of the last round of QT in September 2019. And in a recent speech just about a week and a half ago, Vice Chair Barr stated that promoting the substitutability between reserves and reverse repos increases financial stability and monetary policy efficiency. Now, let me turn to costs that maybe haven't been discussed yet, but ones that I think are kind of significant, which at least viewed partly as an insider and then as an outsider. It seems that as the Fed's balance sheet becomes unbounded and large, the Fed just becomes more complacent about having such a large balance sheet. So, for example, in the December 2018 FOMC meeting, when the staff pitching the floor system told the committee that about $1 trillion in reserves should be necessary, Powell said, well, if that necessary amount needs to be higher, like maybe $1.5 trillion, he'd experience buyer's regret. Well, the most recently publicly available staff estimate, as I said, is for that they need $3 trillion, and there have been no expressions of regret. Now, perhaps, and then some of the problems are that the Fed seems to be more able and ends up monetizing the debt. Now, I don't really exactly know what monetizing the debt really means, but luckily I don't have to know because Ben Bernanke defined it for me in testimony before the House Budget Committee in 2011 when he was asked, well, are QE1 and QE2 monetizing the debt? And he said, no, they're not monetizing the debt because if they were monetizing the debt, we would be holding on to these securities. We're gonna get rid of these securities. We're gonna shrink our balance sheet back to the small way it was before then. So by that standard, the Fed's left monetizing the debt in the rearview mirror. But also, perhaps more dangerously, at times monetizing the Fed ends up having to monetize the debt. So Randall Quarles here at this institute in 2020 explaining the Fed's actions, he said that the Fed may have to remain engaged in asset buying for some time simply because financial markets are dealing with too many treasuries to handle on their own. Now, I won't talk about interest rate risk at length. My impression is that, so if you go back to 2002, the staff did a big study on the balance sheet, and they developed principles for the balance sheet. And those principles said interest rate risk is just the same as credit risk. And if we're going to incur a lot of it, we would take that very seriously, and we would want to talk to Treasury and Congress first. Well, if you look as an outsider at QE4, it sure felt like it was sort of casually backed into. Now, certainly, I'm of the view that the initial massive purchases were worthwhile, but then they just continued and the explanation changed from one thing to another, and they were locked in with very rigid forward guidance and a long promised taper, adding to that interest rate risk, but also, I think, delaying, as was remarked earlier, the necessary liftoff in interest rates. Now, if I had time, I would also talk about decisions to have the Treasury and money market funds and GSEs and foreign official institutions shift massive amounts of funds to the Fed's balance sheet, decisions that were made, I think, on the view that it didn't really cost that much to have this happen. Perhaps, I think, the most dangerous cost is that the Fed's balance sheet becomes an irresistible way for others to pay for things. And this was a cost that was, for example, called out by Charlie Plosser, proud SOMC member, in the June 2011 FOMC meeting. So in which he said, without some constraint imposed on the size of our balance sheet via an implementation framework, we might find it difficult to find ideas preferred by others as to how we might use that balance sheet. And Randy Quarles in November 2018 said that that giant balance sheet and that unbounded balance sheet is what lawyers call an attractive nuisance. An attractive nuisance is something that is irresistibly appealing to passersby of impulsive and immature judgment, such as children and congressmen. Now, I'll say in the same meeting, Loretta raised the same concerns, but not quite so pithily. Now, this is not an abstract concern. The financing plank of the Green New Deal is basically the Fed will print money and pay for it. The CARES Act of 2020 encouraged the Fed to create a lending program for middle market firms. A 2021 nominee to head the OCC proposed that the Fed give everyone accounts and put money in the accounts of the underprivileged and worthy businesses, expenditures the Fed would finance by driving its equity negative. The eCash Act of 2023 would have directed the Treasury to create a digital currency, paying for the expenses by overdrafting an account at the New York Fed. And the Bitcoin Act of 2024 would have directed Treasury to acquire a stockpile of 1 million Bitcoin funded with Fed capital and profits. Now, relatedly, the unbalanced Fed, I think, puts Fed independence at risk. Nothing in the law guarantees Fed independence. The president could nominate and the Senate could approve board members, including the chairman, who would agree to take direction from the administration. And I think the prospect of using the Fed's balance sheet like a giant sovereign wealth fund adds to that enticement. Now, one of the advocates of the floor system say that its main advantage is that it satisfies something incorrectly called the Friedman rule. It's sort of called so basically, the Fed can produce reserves for free, so it should produce them until money markets rates equal the IORB rate and their opportunity cost is zero. But that's wrong for two reasons. First of all, the costs are massive of having an unbounded Fed. They're high, not low. The Fed, and more consequentially, the Fed, well, equally consequentially, the Fed already satisfied the Friedman rule. A line of credit and a deposit at a bank are economically nearly identical. Both are promises by the bank to provide the Fed on demand. The Fed had been providing free, no questions asked lines of credit at the discount window since 2003, and free collateralized intraday credit since 2008. And they were doing that for basically the same reasons, and they were slowly working. Okay. So I think there's reason to think the Fed's becoming an outlier. The Bank of Canada, the Bank of England, the ECB, and the RBA are all doing similar things. And there's reasons to be optimistic. Now, for those of us, especially for those of us who think the Fed should have a light touch with the financial system. Now, for those who think that the Fed should have their finger in every pie, that maybe not such good news. So the Fed recently stated that banks could look to the discount window and standing repo facility instead of reserve balances as the means to meet a deposit run. The Fed now talks about reducing reserve balances until money market rates are a bit above the IORB rate. And that combination of letting banks hold fewer reserves and giving them a financial incentive to hold fewer reserves could gradually reduce banks' demand for reserves, allowing the Fed to get much smaller. Thank you.
Thanks very much. So as Loretta said, we spent the earlier part of the day talking about where the FOMC targets rates, but it doesn't work unless the market actually uses interest rates that are close to the target. And that's what this panel is about. It's about how does the Fed implement in the market the rates that it's targeting. I want to talk about a different problem than the ampleness of reserves. I talked about that in a conference here in May, and I think the panel totally agrees on the implications of whether or not there are sufficient amount of reserves in the system. By the way, I wouldn't agree that we just say, we're just going to lower the amount of reserves in the system and make the banks hurt so that they can deal with less. That's a very problematic approach. I was actually in China in August 2015 when the PBOC swore to its banks that it was going to starve them of reserves because they were too hungry for reserves. And when the markets blew up, the PBOC didn't have any other option than to supply reserves. Fed is always going to do that when it comes to a crunch. So we can't simply wish down the size of the balance sheet. And I'm going to come back later with some policy ideas for how to mitigate some of these concerns. But I want to talk about a different aspect of the corridor system, not related to Poole's curve, but rather to the capacity of the largest financial institutions to actually lend more reserves, even if they had tons of reserves. And that's related to their ability to expand their balance sheets. So just 2 weeks ago, we had the end of another quarter, a quarter on which not US banks, but foreign banks have to show their regulators they have enough capital. And of course, what they do is they expand their assets in the middle of the quarter, and then at the end of the quarter, they shrink their assets so that it looks like they have enough capital. US banks don't have that problem. They're based on, their capital requirements are based on daily averaging. But that doesn't mean that it doesn't matter in the United States, because when those foreign banks pull out of US money markets on the end of a quarter, all hell breaks loose on some quarters. This last quarter end, it wasn't a total disaster. It wasn't like September 2019, but it should have sent shivers through anyone that's monitoring the effectiveness of the corridor system or the floor system for implementing US policy rates. And it also should give concerns to those who are worried about whether financial institutions that actually need money are going to be able to readily get money on future quarter ends. So what happened on this quarter end is that when mainly large European banks pulled out of the market, all of that lending that they would have done had to be done by US banks. There were also some additional demands for lending on the end of a quarter because it's a Treasury issuance day and other things are happening. And you can see what happens in the repo market, which is the market that really matters, as I'll emphasize later, when targeting US interest rates, it's the repo rate that matters. This is one sample of the repo rate called the GCF repo rate. I picked it because it's the most regular. It's centrally cleared, as a uniform set of collateral. It's general collateral. It's one where you can actually see the shadow price of funding in the repo market. And you can see it was regular as all get out until the last day of the quarter, sitting 1 basis point below that floor, below the interest rate on reserve balances. So very, very effective implementation of monetary policy. But then on the quarter end, because capital requirements started to bind, not the ampleness of reserves, but capital requirements started to bind, that rate shot up to 5.22%. On the next day, there were still problems in the market. It was 5.16%, and then it went right back down to normal within a couple of days. Why does that matter? It matters because there's not only a floor on this system, which is the interest rate on reserve balances, and as Loretta explained, there's a backstop, which is the reverse repurchase facility rate. There's also implicitly going to be a ceiling that prevents these kinds of problems showing up in money markets. And those ceilings are the discount window for banks and the standing repo facility for repo dealers. And the largest players in both markets are bank affiliated. They're subjected to the same capital requirements. So these large bank dealers can't really step into the market aggressively on quarter end because their balance sheets are constrained. And that's why they don't go to the standing repo facility to get additional funding. So for example, the bank of Mike Bordeaux, who's sitting here, he could have said, well, I don't really need to pay 5.22%. I could go to the Fed and I could get funding at the standing repo rate, which is 5%. That's 22 basis points lower. That's a lot. And it's a multi-trillion-dollar market. But he doesn't do that. Why not? Why wouldn't he take the opportunity? On October 1, there was $600 billion of repos conducted by large banks at rates above 5.14%, $600 billion. But the standing repo facility took in $100 million on that day. So why weren't those $600 billion obtained at the Fed? If they had to be obtained, why weren't they obtained at the Fed at a much cheaper rate? It's because, and Bill is an expert on this, the discount window and the standing repo facility, it's not a good look for those largest banks to use those. There could also be some teething problems because this is the first time that they've actually been used. But the extent to which these safety ceilings on market interest rates are actually used is a concern. And this is the opposite problem to the, or not the opposite, but it's a complementary problem to the ampleness of reserves. The problem is basically that the bond market is getting too big relative to bank balance sheets. And that's not the fault of the Fed, it's the fault of the fiscal authority. It's borrowing so much money that the quantity of bonds that need to get financing in the repo market is growing by leaps and bounds relative to the sizes of the banks that intermediate those markets. So the vertical axis on this chart is the ratio of total treasuries outstanding to the total size of all primary dealer balance sheets. And pre-crisis, it was looking kind of good in terms of capacity of the market. The quantity of treasuries per unit of balance sheet was going down, and that was based on light regulation. The banks would basically have no problem expanding their balance sheets whenever they wanted to get a few basis points of arbitrage because they weren't they weren't lightly even regulated for capital. Then after the financial crisis, many of you got religion and said, we need financial stability. We have to regulate these banks for capital. And that meant that these banks' balance sheets were not going to grow fast. Meanwhile, the US government was borrowing money hand over fist. And now we have roughly 4 times as many treasury securities per unit of balance sheet space as was available on the eve of the financial crisis. So the bond market is just basically too big. And that's why we saw this blip at the end of last quarter. There's just so much demand for financing relative to the available capital at the dealers. What about the Fed funds market? I added to the same chart the effective federal funds rate on those days. Wow, the Fed nailed it. 4.83% day after day, didn't budge on that really bad day on the end of the month. Why not? Well, Loretta and Bill already discussed this. The federal funds market is kind of an artifactual market sitting way on the side of money markets. I'll show you, and this is my last chart, I'll show you to scale the size of the repo market compared with the federal funds market. So the big blue blob in that big rectangle, that's a recent estimate of the repo market. Actually, it's a big underestimate because a lot of repos are now being found out in the bilateral unmonitored market, and they're starting to get measured. Recently, the Fixed Income Clearing Corporation cleared 9 trillion of repos in one day, a record. Now let's look at the federal funds market. That's the little red rectangle down in the bottom right of the screen. And that's about 98 billion last measured. So it's very small relative to the repo market. And of the federal funds market, most of it is this artifactual trade between federal agencies that don't get any interest and European banks that have these lighter regulations. So the European banks are basically entering into a negotiation of split the pie, which is an artifactual way to set a rate. The tiny, tiny little green rectangle at the bottom right, if you can see it, that's the actual amount of borrowing by US banks in the federal funds market. It's about 5 billion a day compared to the 4,000 billion in the repo market. So the repo market is the engine room of money markets. That's where the Fed is hoping that when it targets a rate, the rate actually takes a grip on markets. And nailing it in the Fed funds market, well, it's nice for communication purposes, but it's not really what the Fed is trying to do. The Fed is trying to actually get the larger money markets to follow the rates that it's setting. So what can the Fed do, and what can policymakers more generally do to help this problem without, as Bill said, without blowing up the Fed's balance sheet a whole lot more? Well, one of the things the Fed can do is to innovate its payment system. Other central banks have found a way to get a lot more of the uses, the intraday uses of payments done with a far smaller amount using what are called liquidity savings mechanisms. So things like incentives and rules that move the money through the system faster in the middle of the day so that banks don't have to start the day with so much balances. Another thing that the Fed could do is to take this standing repo facility, which is the floor, which is the ceiling in this picture, and expand it to a wider set of counterparties. Loretta alluded to this, and a G30 report that was chaired by Tim Geithner, to which Jeremy Stein, Pat Parkinson, and I contributed, suggested that this standing repo facility be made available to a wider set of market participants so that we wouldn't be depending on the capital-constrained banks to intermediate the 100% of this market. A lot of the funding, when you're going to blow through that ceiling, could be obtained from the Fed. Now, that's kind of antithetical to this footprint problem. However, there's a mitigant to that, which is the Fed doesn't have to face every one of those non-bank counterparties, non-dealer counterparties. It could face the time. Okay, so it could instead centrally clear that wider set of repos so that it's only facing the central counterparty, doesn't have to vet so many market participants. The last one I mentioned, since I'm running out of time, is that not all as today, not the vast majority of repos need to be intermediated onto bank balance sheets. We could have a money market in which borrowers and lenders can face each other directly, even if they're not banks. And that's called direct repo. It's a pretty active market in Europe. And it's hard for the Fed to mandate that, but the Fed could encourage or foster the growth of direct all-to-all trading in the repo market. And then we wouldn't depend on this balance sheet problem. Thank you very much.
Maybe a question to Loretta Mester or Darrell Duffie. Actually, all three. So Harold Ulick, University of Chicago visiting fellow at Hoover. In the good old times, the federal funds rate was, of course, the key market interest rate. Cash balances and reserves had an interest rate of 0, and the Fed was trying to move that rate up and down. Everybody was staring at that, and that was in Darrell's language, the elephant in the room. Now the federal funds rate is a I'm sure it's important for some players in the market, don't get me wrong, and there are millions, billions of dollars moved there, but in the overall scheme of things, it's something that we can pretty much neglect. And I'm even not sure that the repo rates that Darrell showed are all that important. I mean, I think I agree that once you open the discount window to a larger set of institutions, once you make the discount window equal to the interest on reserves, and once you put more, I don't know, hand-holding into the financial market so that financial market players really use that rather than having teething problems and having problems borrowing from the Fed rather than from private market participants. Many of these frictions seem to go away as far as a bigger macroeconomic picture are concerned. Now the interest rate on reserve is really the key interest rate, and that's the one that's moving lending conditions up and down. The federal funds rate and maybe even the repo rates, are a sideshow to all of this. So why are we still talking about the federal funds rate is my question, other than, having the small frictions go away.
Okay, so I'm going to trust to Jeff Lacker to make his question really short. Then we're going to go John Cochran, and then we're going to have the panel respond quickly, and we're going to go to break.
I agree that a large Fed balance sheet opens it up as a target for special pleading for people who want to have the Fed participate in credit allocation. This has been a problem under the corridor as well. Ever since the 1951 Accord, discount window lending has been divorced from monetary policy because the Fed could always sterilize any lending. And this is why the FDIC and the FDIC and the OCC came to the Fed for lending for too big to fail banks. And it's why Proxmire pressed the Fed, forced it to start buying agency debt, including the debt of the Washington Metro in the 1970s.
Excellent question. John.
Thanks. This was wonderful. You guys have focused on the question of how does the new regime affect interest rates properly? And the answer I hear is, you want to nail a price, you need a flat supply curve for all comers. And if you want to fool around with something other than that, you're going to have trouble nailing a price. But you left out, you didn't address the other big question, I think, of the interest on reserve regime. And here the ghost of monetarism is creaking in that coffin in front of us. We now, back in the old days, there was a rationing of quantities and there was an opportunity cost of liquidity. And now, even though I love it, we live the Friedman rule, we live a permanent liquidity trap. We're hoping that interest rates transmit to the rest of the economy entirely through prices, with no change in quantities, no opportunity cost of liquidity, no rationing the means of transaction, so forth. I kind of like that, but I'm a little nervous about it. Among other things, interpreting history. Was 1982 really just about the cost of freely provided interest rate lending, or was there something involving the machinery of the financial system? Maybe it's better now, maybe it's not. Maybe the Fed is going to have less trouble. Anyway, answer that ghost.
Okay, super quick answers.
Right. On the Fed funds rate as the target, Carl, yes, you're right. Partly, if you go back and look at the transcript of that December 2018 meeting, you'll see there was a big discussion about whether we should change the target. At the end of the day, it was decided not to. One, I think because people were comfortable with the Fed funds market. It was all it's how do you communicate? You're exactly right. The control is the administered rates. This is about communicating policy. But the other thing that's an undercurrent there, and Charlie Plosser has talked about this also, is there's governance issues. If you were to switch from the Fed funds, right, then you have to say it's an administered rate. That's not an FOMC decision. And I think that also played a role in sort of like punting, like, okay, let's keep it. We seem to be able to control it. It's linked to other, we can link these short-term money market rates together, and we're controlling them, and let's punt on that.
Yeah.
But I think it's open.
Darrell.
for Further discussion.
I'll try John's and I'll leave the Proxmire one to Bill. Well, John, it's to some extent, it's not really costs and benefits when you're up against the wall. It's not feasible in the current regulatory framework to steer rates by scarcity of reserves, because banks are required in the current regulatory regime to prove that they have enough liquidity on their own without relying on the Fed. So they have enormous demands for reserves to meet their liquidity needs. And we can't really go back to a world in which you could squeeze them down to the point where they just barely have enough reserves to lend to others. The needs that they have for meeting the regulatory requirements and payment needs in the course of a day are orders of magnitude bigger than the adjustment you would need to make on a daily basis to target the rate. So it's just not feasible. Don Cohn taught me that in my
Darrell.
first encounter with him.
I got to turn to Bill next.
Okay, so I'll take a shot at Jeff's question. I completely agree. These pressures existed before, but as I think was Charlie's point, and certainly I agree, back under a corridor system, the Fed could be no bigger than a little bit bigger than the demand for currency, and they couldn't control the demand for currency. But now, and now they could be under this system, they can be as big as they'd like. So.
Okay, thank you very much, panel, for an excellent session.